think, act, and prosper. You are now tuned into the Money Level Show.
Hey everybody, welcome back to the Money Level Show, where we think, act, and prosper. Today we got a returning guest, David Morgan. David Morgan is a widely known and recognized analyst in the precious metal space, and he runs the Morgan Report, which focuses on precious metals investment and gives a lot of knowledge in terms of the precious metal space. So we're thankful for you to be here today, Dave. How's it going?
Yeah, it's going well. Thank you. And just a little add on there is the Morning Report covers money, metals, and mining. And we look at all the metals, all the elements, and a lot in the mining resource sector. So back to you.
I like how you said money, because gold is money. Everything else is credit, right?
Right.
So yeah, appreciate you saying that. I was just browsing through the website the other day, and I noticed that you had a article that talked about a few different components that were very concerning. One was the decline of the dollar on your website, the Morgan Report. You point out the fact that the dollar has lost 98% of its value. I think this is obviously a longer term trend due to how long the value has been declining. However, in the short term, the dollar can be used as a hedge against downside risk in the market. So I just wanted to know, how are you positioning yourself currently, and what's your take on the risk of recession and liquidity crunches?
Well, great. There's a little bit to unpack there. First of all, you're right, Daryl. The $1913 now worth about 2 cents. And it's been pretty much a downhill slope most of the time. However, the acceleration phase started in 1971 when the dollar was cut from gold. So it was going down, but kind of at a moderate rate. And then after 50 years ago, it's accelerated its downward climb. However, cash beat out the S&P last year. The full year 2022, cash was a better place to be than the S&P, a better place to be than the bond market, a better place to be than this real estate. Excuse me. And then gold was pretty much level, so money itself stayed flat, and in dollar terms, it was about equal, and silver actually was up a few percent, like 2 or 3. The point being that sometimes in the markets, that holding your own is better than being invested, because you've taken 20%, 30% loss or whatever it is, or potentially taking losses. You don't lose unless you sell. So definitely right now I am doing a private placement with our mastermind group, which is a copper deal that I really, really like. It's in Montana. I have not visited the property, which on these type of situations I almost always do, but it's kind of hard to get a good feel for the place when you're looking at 4 feet of snow. But enough creds on the people that put this together, and the team. I don't know them all personally, but I have gotten to know them, and so it's a speculation at a high level, but it's really good. So that's one I put some money into. The rest of it's pretty much been building cash. As much as I'm anti-fiat, there's times you're better off there than in the market, as we just outlined. And I'm also positioned in platinum. I may be adding to it. And a while back, I also put on a spread trade. I'm long platinum, short palladium. That one keeps just working in my favor more and more and more. So I'm not really zooming in to pick up a lot more mining companies at this particular juncture. I think that long term, it's a great time. I try to time the market. No one can do it perfectly. Even the algorithms. I mean, you can buy these trading softwares all day long, and they all promise the moon. And some are better than others, but none of them are perfect. There's nothing you can do in the market that is a guarantee, other than perhaps the massive computers that are sitting, milliseconds away from the Wall Street trades, and they take, just a tiny fraction of what the spread is, but they multiply it times billions of transactions. Anyway, I kind of digress. But building cash, one copper position, platinum. That's all I've been doing in the last few months.
Yeah, cash is, obviously very important, especially if we have a liquidity crunch where you can get a lot of these assets very, very, very cheap. And so you mentioned that you were short palladium. I saw palladium is taking a big fall. I think it was last year sometime was around $2,000, and it's been anywhere from 13 to 1400 the last I've been checking it. What's going on with palladium? What's the reason for?
Hey everyone, sorry to interrupt this interview, but I want to let you know about this important resource, the Rule Symposium. The link is in my bio. Be sure to click that link and check out the site for the Rule Symposium. This is a symposium that Rick Rule puts on every year. From this year, it's going to be from July 23rd through the 27th, and you're going to be able to hear from some of the best in the space. You're going to be able to shake hands with some of the best in the space. He's going to have guests and presenters such as Jim Rickards, Nomi Prinz, Rick Rule himself, and many others. And these are going to be people that have built billion-dollar businesses, people that have made a lot of money in investing in the natural resource space. So be sure to click the link in the bio so that you can check out the Rule Symposium. That is the Rule Symposium. Check it out. And I appreciate you all for clicking that link and supporting the channel in that way.
But just to modify what you said a little bit, I'm short palladium and long platinum as a spread trade. So, for example, you could make money if palladium goes down and platinum goes up, which has been happening. Or you could make money if palladium stays the same and platinum goes up, or palladium moves up slightly, but platinum exceeds its rate of return. So say platinum is going up at 10% compounded every month, which is an exaggeration, but palladium's only going up at 2%. You're still going to win on that trade. So I like spread trades. I've done very well with them. In fact, I've hardly made any mistakes on spreads. I have, but anyway,
I'm going to talk offline about that. I need to learn that from you.
So another one is the liquidity squeeze, and I forgot to unpack that. Yeah, the liquidity squeeze, I mean, cash is king. And, the ultimate cash is obviously gold and silver. But in today's world, it means the dollar primarily. But the dollar is being de-dollarized, as you know. So how long is it going to hold its front position? Well, sometime longer, no doubt. But it is losing traction against other currencies because other currencies are being used instead of the dollar. As far as building, cash for bargains, yes. If the real estate market's going down, it's best to let it bottom or close to it before you invest. Same things with stocks or bonds. So patience is a virtue. I mean, we're at that time of the year, Daryl, where, sell in May and come back after Labor Day. Probably will hold. The summer months are not really that good most of the time. The seasonality is pretty good. In other words, pretty good just to leave in May and wait. Not always, but generally it is. And also for the metals. The metals usually hit the doldrums in the summer. This year, I'm not convinced. There's been record buying the first quarter in gold. Central banks still are accumulating gold at a more rapid rate than they have in years. That was true for the whole year of 2022. And if you look at the underweighting of gold versus where the asset allocations were in the 1970s, I'll be presenting this at the Money Show in Las Vegas. I'll be speaking there on Wednesday next week. And got some pretty powerful slides, a couple from friends of mine and a few of my own, outlining how much money's on the sidelines. So I want to unpack that, Daryl. Right now, there's about $5 trillion. Yes, Daryl, I said T, $5 trillion sitting on the sidelines. Now let's just think about this for a minute. $5 trillion. What's 1% of 5 trillion? Well, let's do it in my head. Okay, hey, I got the number. It's 50 billion. All right. So 50 billion is 1% of the money sitting on the sidelines. Imagine if that money found its way into the silver market. What would that mean? Well, here's what it means. At $25 silver, the entire annual silver supply mined and recycled is 25 billion. So 1% would represent 2 years of all the silver that exists. And that's if only 1% of the money found its way into silver. Well, if you go back into the 70s and you saw the asset allocations, and they vary, I've seen several, but 5 to 10%, and we're sitting at less than 1% now. And in a liquidity squeeze, you go for the safest place possible. And I use the extra pyramid. I don't recall, Daryl, if we've talked about that before. You can look it up on the web, EXTER pyramid. It's a representation of an upside down pyramid that shows exactly what happens in a liquidity squeeze. And what happens is, again, what I said, you go to safety, which means the US dollar until you're scared of the dollar. And then you move to gold and silver. And when that happens, there could be a lot more than 1% moving to silver. So when I give my speech in Las Vegas, is silver an asymmetric trade? I'm going to bring in this point up during my lecture. And of course, I'll ask the audience for feedback after I'm, done accomplishing my presentation. This is something that people like you, Daryl, are doing a great service to others, because anyone that understands what we're talking about has an opportunity here that I don't think it's a once in a lifetime opportunity. I think it's a once in centuries opportunity. We're looking at a situation that isn't a currency failure every 100 years approximately. We're looking at a total shift in the whole economic system that only happens every 400 or 500 years. That's what we're looking at.
Wow. Yeah, that's amazing. I did a video recently on the gold to silver ratio and the historic ratio being around 15 to 1 or 12 to 1. I think Isaac Newton said it at 15 to 1. And so right now, I think the last time I checked it, it was about 80 to 1. And we've had a few runs in silver where that ratio was closed as low as I think it was about 15 to 1 in 1979. And then so it seems like it's inevitable that this ratio is gonna close. The gap is gonna close at some point.
Right. If we just go back to what it did during this bull market, and I know it's been kind of I'll call it an ugly market for the last decade. But if we go to the first decade, from a bottom of 252 gold in 2000 to a high of over 2000 in 2011, September, that's a nice run. And now we've been going through a consolidation that's taken much longer than I expected, but nonetheless, here we are in 2023. We're back close to $2,000 gold. When we see what's ahead, what I just outlined, we are going to see the ratio move in silver's favor. Why? Because in all bull markets so far, at least the recorded one, the ones that we have, from time immemorial or recorded history, silver outperforms gold in a bull market. Now, the idea that we could get to what we've already seen, that's 33 to 1. So if we're at 80 to 1 now, 40 to 1 would be silver outperforming gold, by a factor of 100%. It'd be double. In other words, $1,000 in silver would return, twice as much as it would in gold. Gets to 33, it'd be even better than that. If you go to 16, the historic, or what I call classic ratio, the monetary ratio, you just took that 33 and halved it again. So you're doing 4 times more than gold. And if it goes below that, which I think it will this time, or I should say, I think it has the potential to. And why? Because of the solar voltaics, solar industry, the photovoltaics, the demand from industry, and the monetary demand from the public, and even some smart money in pension funds, hedge funds, money managers, family offices, are just rich individuals that know what the heck is going on in the silver market. I think once we break through 50 to the upside, then the sky's the limit. Is 55 the top? I don't know. Is 100 the top? I don't know. But if we get to those ratios where, let's say, it breaks through and makes a new low historically to like 12 to 1, what was the natural ratio back in the 1300s? Now you're talking, maybe 5 or 6 or 7 times the performance of gold. Now, I do advocate having both gold and silver. Why? Because gold is establishment. I know you would probably agree with me when I build my case. I mean, central banks buy gold, nation states buy gold, but they don't buy silver for monetary purposes. Some buy it for strategic reasons, but it's safer. It's just plain safer, but it doesn't have the potential to move like silver does. So I think, the more conservative you are, you want to own money and not invest really. I mean, think about buying gold. Are you really investing in gold? Yes, I can make that statement, but the truth is no. What I'm doing is I'm stacking real money that's going to keep its value so I can invest when things turn around and get realistic again. I mean, when you have the debt to GDP ratio that we have now, which is beyond or right where we were in World War II, but we don't have the industrial capacity per capita that we had back then. In other words, we don't make stuff anymore, or very little. We are in a different paradigm. We are in a situation where we really cannot dig ourselves out of this. We're going to have to admit that we failed in many areas and reap the repercussions of those failures, which means, what do we see? Big box stores, Best Buys are closing down at 25 stores. You've got several other stores, even big name stores like Nordstrom's. And so this is a contraction of the economy. Why? Because the money system is breaking down. People are going broke. The highest stress levels in this country, 85% of the people in the US of A stress about money. So that's where we're at. I'm not here to paint doom. I'm not here to be gloom. I'm here to be real. And the real truth is we have a problem and we created it, or perhaps I could argue the banks created it for us. But living beyond your means, buying today and paying tomorrow, wishing that inflation always bails you out, and at times it will, is now being challenged because we're having bank failures and we're having systemic risk that is not mitigated yet. And it will be, in my view, a worldwide problem.
Yeah, and just unpacking that a little more. So you mentioned, so we were talking about silver. Obviously, like whenever the liquidity crunch comes, I see many times like gold and silver take a fall before it bounces back. You had mentioned that people go into the dollar, then they move that money to silver. So I just want to clarify that for the audience when we're talking about silver going back to the historic ratio, or even better than that. Would you see that as we come out of recession in terms of the industrial use? Because doesn't production and businesses slow down in the midst of recession?
Yes, and it's really not that complicated, but I'll do my best to make it clear. So 70% roughly of the silver market is byproduct mining. 25% of the silver above ground is due to copper mining. 35% lead and zinc mining. 13% of the silver market is a result of gold mining. Only 25% is a result of what we call silver mines. But every silver mine today is a gold silver mine, a copper silver mine, predominantly silver, but there's other metals with it. And the point is, if we have a severe recession, we won't be digging up as much lead, zinc, and copper. So that will mitigate the amount of silver that comes above ground. And the mining industry's already been flat since 2015. So we've got 8 years where the silver production has not increased. If we have a severe recession, it would probably decrease even more. At the same time, in some jurisdictions, not all, Daryl, but in some, photovoltaics, solar panels, is the cheapest energy per kilowatt. Well, isn't that a concept? So you're inclined to maybe use solar for your electrical power. And I don't think that's going to stop. There's a lot of forward-looking statements, and so be cautious, but there is a huge demand for solar going forward. I don't think, recession or not, that's going to stop. I think it will continue. And the other side is recession, depression, or inflation or hyperinflation. Any scenario you want to choose, gold does well. And silver is 85% correlated to gold. So the argument that, well, we're in a recession and silver doesn't do good in a recession, that's really not true. I mean, there's times when it doesn't do well in a recession. That's true. But what we're facing, if we're in a, let's call it an inflationary depression, or you could be kind to say inflationary recession, where we keep printing money, its value becomes less and less and less, silver will do well in that environment. If we're in a debt liquidating depression where we have a huge contraction, which we're experiencing now in the bond markets, fails further, then cash does become more valuable, but that doesn't mitigate the fact that silver could continue to move up. So I think the way to approach the market is, what you said on some of your programs is you got to value silver in terms of how many barrels of oil does it buy, how much real estate does it buy, how much of a business will it buy. That's the way to look at the value of precious metals, not how many pieces of paper is it worth. Because if you looked at it in terms of paper in Zimbabwe, it'd be meaningless. Or Venezuela, it'd be meaningless. Or Argentina, it'd be meaningless. Right now, everyone measured it pretty much against the dollar because the dollar is still king of the hill. But I don't think for a lot longer. The dollar isn't going to go away. I'm certain we will have a new financial system or a new monetary system structured, and we're either going to accept it or not in the near future. And at that time, the dollar will be, let's say, consumed or made part of the new system. So I don't see the dollar going to absolute zero. There could be, and this is unlikely but plausible, that the perception that the dollar is going to zero could take on a mass consciousness. In other words, over half of the population of the United States or half the population of the world thinks the dollar is absolutely going to zero. It hasn't, but they're fearful that it is or it's going to. If that's the case, and I'm not saying it will be, in fact, it's remote, but if it were, there'd be a panic buying in the metals like you've never seen in your life or any life. It'll be a record setting of it.
Yeah. Yeah, for sure. Could you share a little more about the, well, I don't think I didn't ask you this yet. Could you share about, so I know when we went in October, gold and silver took a, pretty significant dive. And then silver was below $20, but the premiums were still pretty high. So I'm trying to figure out how does that work, because I know like usually the premium, it'll usually when the price goes down, like you would think you would get it cheaper, but a lot of times those premiums can be, go higher.
Yeah, that's pretty easy to define, really. There's really two silver markets. I mean, you can say there's several, but basically there's two. There's the silver market, which is a derivatives market. That's what the silver market is. It's a futures market based upon a contract, a piece of paper. And the LBMA is roughly the same. So the two places that have the most above ground silver for sale that's known are the LBMA, London Bullion Metals Association, and the COMEX, the Chicago Mercantile Exchange, or the NYMEX, the New York Mercantile Exchange. You can buy a contract and ask for delivery and buy silver at 18 when it's $18 silver price. That happens. But those are big blocks, 1,000 ounces approximately, and you take them off the exchange. If you bought it at 18, Daryl, you pay a little more than that. You have to pay for the days that it's in your name, and then you got to pay for transportation and maybe insurance and maybe a fee to take it off the shelf and then put it in your name or whatever. But round numbers, you're still getting around 18. At that same time, the retail silver market, which is your silver wafers, your silver 5 ounce, 10 ounce, kilo, 100-ounce bars, or your 1 ounce rounds, or any government stamped 1 ounce coin, be it from Canada or the United States or Australia or Austria. All of those have a huge premium. Why? Because it's a very small market and there's a huge demand. So to meet that demand, you've got to bid it up. So at $18 silver, if you want a silver eagle, you might be paying a 40% premium. And I think we saw even higher than that at one point. I think we saw 50% premium. I don't want to misstate it, but you've got the idea. If you wanted to buy a silver bar of 100 ounces, that would still have a higher premium because there's only so many 100-ounce bars available for sale. And the people that have them that maybe bought them at 18 the last time we're at 18, which I don't know, I have to look at a chart, but let's say 5 years earlier, and didn't have the markup that exists now. So maybe they paid 20 or something. Now they're getting 24 for an $18 purchase that they paid 20. So they got $4 on 20. That's a pretty good markup. Okay, I'm going to sell my silver bars. So that's the way it works. The retail market is really separate from the silver market, which is a derivatives market.
Yeah, that makes total sense. Especially when I see prices on eBay and such. For silver eagles and such, those premiums are super high. So I had a question come in from one of my subscribers, Indivisible Man, 8596. He wanted me to ask you if physical silver products have a more liquid market than the stock market.
By far. You can take a silver or gold coin almost anywhere in the world and barter with it. If you had a complete electrical shutdown as a thought experiment, really the only thing standing would be physical cash or gold and silver. I mean, you're not going to take your shares of Newmont Mining and sign the back over to somebody. I mean, you might have a really sophisticated investor, but no, the most liquid things are the physical metals. If you go, let's just dive in that a little bit deeper, Daryl. We go back to Argentina. They have a currency crisis about every decade. And in those instances, people barter with silver jewelry. I mean, yes, there's silver coins, but most people in those environments are holding silver rings, silver necklaces, silver bracelets, that type of thing. And they are readily available to barter for, fruits and vegetables, a blanket, an overnight stay, a hotel, whatever. So that's your most liquid place, especially outside of the US. I mean, here, Canada, North America, I probably should say, we're used to our debit cards, our credit cards, our currency. But a lot of parts of the world that are, let's say, more in tune with reality, they actually will barter with, physical metals. Not all the time, not everywhere. I'm talking about specific instances, but that's the answer. The answer is the harder the times are, the more valuable those type of monies.
Makes sense. Makes sense. And then I was wondering about what's happening with Jamie Dimon, J.P. Morgan, and I think it's GLD. I've been seeing some things on that. I'm sure you probably had your finger on the pulse of what's happening there.
I really don't. I mean, you can give me some more input. I mean, I do know that Diamond said that the banking crisis is far from over, which is one of the things that's truthful that's come out of his mouth. They are the custodians for the GLD and the SLV, the two largest asset holding companies for physical gold and silver. That is really a paper trade. I mean, unless you're a registered participant, I think it's called, there's a term that if you're at a certain huge level, you are able to take physical off of it. But most all investors otherwise are stuck with a piece of paper that represents the price of gold or silver. But what exactly is going on with GLD? Give me some more info. I haven't read it. I've been writing the report. I've been pretty buried with the task at hand.
Yeah. I've just been seeing some tweets on Twitter about it. But yeah, it was just along the lines of, I guess, how much of GLD they own, and like if delivery has to take place or something of that nature is way above my head. So
yeah, well, I could comment now that you gave me that input. I mean, it's true of the COMEX as well as the GLD. There's a lot more paper claims on those derivatives. But remember, that's they really are trading this paper back and forth all day long, every day. And then occasionally someone says, "Oh, this piece of paper, it's supposed to be good for some gold. Give it to me." you want to make the analogy to what happened to the dollar in 1971. I mean, basically, the dollar was a dollar standard, really. The dollar was backed by gold at $35 an ounce, but everyone was just trading dollars all day, every day, until a few people said, wait a minute, it looks like you got a heck of a lot more dollars out there than you have gold. And if your contract's good, here's your dollars back. Let me have the gold. And once that started happening, it was called draining the gold pool. And Nixon had to close the gold window, really, because otherwise, all these promises to pay that were invalid because they had created a lot more paper than there was gold to back it up, he had to stop. And that's similar to what's going on here. If everybody that had a paper claim demanded their gold out of the GLD or the COMEX or the LBMA or what's called the over-the-counter market that's opaque. You can't see it. You don't know exactly how much is there or isn't there. In all those instances, there's far more claims than there is metal to back it up.
Okay, yeah, that makes total sense. Another thing that on the article I was reading on the Morgan report, you said that no Bitcoin is not going to save you, so you better have a backup plan. And in this report, you highlighted some key facts, and you stated that while millions pour into in the cryptocurrency space, the number of actual wallets getting fatter is just a small handful. In fact, 98.7% of wallets are valued just under $300. So who is getting rich? So what does 98.7% of crypto wallets being valued under $300 communicate to you?
It communicates that at any time, but particularly in a liquidity squeeze, you want the most liquid asset there is. So let's go back to my previous career in the aircraft industry. What do we put in a survival kit? A gold coin. So no matter where you bail out, be it over Vietnam, be it over friend or foe as we refer to it, that gold is universal, accepted, and usually recognized anywhere in the world. They don't put Bitcoin in there. And if only 3% of the population is really savvy to Bitcoin, the other 97 point whatever percent have it as a nice to have or to be cool or to try it out and experiment with it or whatever. It doesn't have any real liquidity. And that's the difference. You want the best money available, especially when times are tough. And that's the precious metals, period. Now, people argue that Bitcoin is gold 2.0. They can call whatever they want, but it's not. It's not true.
Mm-hmm. Yeah. And, it really makes sense, like, when you wrote that, because for me, what it communicated is that, like, many of the people in crypto aren't the big, whales that hold crypto, and people that got in mining at super early or whatnot. And so, they can leave you holding the bag pretty easy. You also spoke about in that article that nearly $900 billion was wiped out in just a few days, which doesn't communicate safe haven to me. You said that the crash wiped out more wealth than both the 2000 internet bubble and the 2008 great financial crisis. So this was alarming for two reasons for me. One, it shows how quick you can get wiped out. Number two, it shows the amount of wealth being wiped out so quick also shows how much value the dollar has lost since the year 2000.
Yeah, I don't really have much to add on. I mean, it's not a scare tactic. It may appear that way, and I'm sure there's people that fall onto the side or hear an interview like yours and mosey on over to the morganreport.com and they start reading, and it scares them, or they blow it off because they've been programmed to say, oh, this is fear porn. But if you are a solid, objective realist, you will see the truth in what we have on there. And you'll be able to understand that perhaps we're in a position where you need to take action. And the thing about taking the correct action is there's not a lot of downside. If you buy extra food, I mean, you can always eat it or give it away. If you put money into the precious metals physically, yeah, you might be paying a high premium, but would you rather see your gold position be cut in half or your cryptocurrency position end in the all zeros? And I'm not saying they will, but there are a lot of cryptos that have failed. And I'm just not a big fan of it. I do have exposure to it. I have it in the report. Pretty selective. I never recommended Bitcoin, by the way. I think Ethereum's got potential. I think some others do. And I am an ambassador for the Load project. If you go to load.one, you can find out more about a blockchain based precious metals backed tokenized system, which I actually think is the way of the future for free markets. I think if we get pushed into the CBDC and you have a wallet that's backed by precious metals, especially in any country, but it's geared for everyone because a lot of, let's say, less rich countries like Mexico, as an example, or Indonesia, a lot of people are outside the gold market. I mean, they're never going to save $2,000 to buy an ounce of gold. Or if they did save 2,000, they probably wouldn't want to buy gold. They might want to increase their, where they live, like have a better apartment or something. But with the load system and being on the blockchain, you can buy gold by the grain, which is like $7, or you could buy silver by the gram, which is less than $1. And that means that they're not forced out of the market. So if you're in Mexico that has experienced severe inflation and you can buy silver with your wallet and stack it, even if it's a gram at a time, and you end up with 3, 4, 10 ounces, 100, whatever it is, you are preventing yourself from depreciating currency. If you look at what silver's price does in almost any currency outside the US, you'd be very happy, right? If you looked at gold in almost any currency outside the US, you'd be pretty happy, right? It's only because the dollar reigns supreme still that in dollar terms, it doesn't look very good. But believe me, if you were stacking silver in Argentina, you'd be a very happy person. If you were stacking silver in Venezuela, you'd be a very happy person. But this isn't something you're going to hear on CNBC or MSN or any of the major financial channels. In fact, they hardly ever talk about gold or silver. They do show it on the screen, but they really don't talk about it. Although I have to be fair, back in the major bull market between 2000 and 2011, I was asked on some of the major financial channels to speak about silver. And I was a fairly much of a regular guest on the Fox Business Channel for a while. So any market that's moving up and gathers a lot of attention, the mainstream financial press, really can't ignore it. But when it's sideways or down, they do tend to ignore it.
Yeah, for sure. Yeah, that's really great information to have. So, Dave, I appreciate you for coming on today. I know you have to hit the road and everything. So could you share more about the Morgan Report, where people can find more of your research and learn more?
Sure. Thank you, Daryl. The best place is really themorganreport.com, and just make sure you get on the free list. I've been shadow banned for years, but I on our mailing list, we give you special opportunities at times. Sometimes we can even get you a discount on coins. Can't promise that. We have done it in the past. Probably be able to do it in the future. Also, my Twitter account's quite active. It's at SilverGuru22. That's at SilverGuru22. And the best thing to do to get a hold of everything for free is just go to themorganreport.com, go to the blog tab, hit the blog button, and you will see all the interviews I do that are publicly available. And off on to the right, there's all the icons for our Twitter feed, our LinkedIn, our YouTube, our Facebook, everything that we do in the public domain, social media wise. I have been making some shorts for Instagram and TikTok. It's an experiment, Daryl. I don't know if my expertise is going to be welcomed on those platforms or not, but you don't know unless you try. And lastly, I think the most important thing is what we do for our premium members. Anyone that wants to consult, if you're a premium member, you get the consultation fees cut in half. And this is not for everyone, but for people that have a fairly good exposure to the banking system and want to mitigate that risk by getting into hard money, sometimes we'll just call up for a consultation just to find out that they don't want to get burned doing a rookie move into gold. In fact, almost everyone that's called me for advice on gold, silver, physical purchases has more than paid for the consultation fee because the markups are pretty extreme. And if you know how to work the wholesalers, which I do, you can save a substantial amount of premium.
Yeah, yeah. Thank you for sharing all of that. You're doing some great work. You all be sure to go over to themorganreport.com. Check out what Dave is doing. Check out the articles, the interviews, everything. Man, we just appreciate your wisdom and just all the knowledge and research that you bring to the community.
Thank you, Daryl.